So what happened with the elections, right? We had a disastrous debate between Biden and Trump. And then Biden, I mean, I don't know if that was a debate. That poor man they put up there as the sacrificial lamb. And but the question here is going to be who's better for the markets? Democrats are better for the markets, or Republicans are better for the markets? A lot of people are going to say Republicans are better for the markets, and you would be wrong, because under the Democratic administrations, actually, the stock markets have done better than the Republican administrations. Now, I'm talking about the benchmark. I'm talking about the S&P 500. Individual stocks, I don't know. However, as a benchmark, S&P 500 has done as good or better than the Republican administrations. But what has happened is that before they put Biden into retirement, poor man, I really feel bad for him. And they made a scapegoat out of him, obviously, but then he's definitely not in shape to run this country or be president for another 4 years. So they slid him to second base and then put Kamala Harris up there against Donald Trump. And before that happened, Donald Trump had a massive lead over Biden, massive, right? And even the stock market the next day went up just for the fact that they thought Trump was a shoo-in to win the election. Well, this is as of yesterday. I mean, look, you guys got to take these polls with a grain of salt, okay? I don't buy any of these things, but I'll put it up just to have a conversation. 53% Kamala Harris, 45% Trump. Kamala is in the lead. Now, there's predictive websites, by the way, that you guys can even go bet on that, by the way. Okay. I'm not telling you to do it. I'm not going to do it, obviously, because nobody knows what's going to happen. I mean, Trump could have been dead, actually, but the point is Kamala Harris, is coming on strong, and she picked as vice president Governor Walz from Minnesota, and they hit the campaign trail, and it seems like the race is going to be a lot tighter than people think, because if it was a Biden-Trump race, Trump was a shoo-in, I'm pretty sure. So prediction markets are now showing 53% chance of Kamala Harris winning the 2024 election. It's Polymarket, so you guys can go to Polymarket and bet on it if you're degenerates. These markets are different than polls, and this is actually a live marketplace. It's like a bookie website, for lack of a better word. So who's better, right? Who's better for the markets? Is Trump going to be better for the markets, or Kamala is going to be better for the markets? First of all, in election years, markets do reasonably well, okay? There is a cyclical election year process that we go through, and the market had this year, I mean, before that little swoon that we had, S&P 500 and the NASDAQ is up a lot more than the yearly benchmarks, over 20%. Usually it's 8 to 10, 11% per year on average, right? So what does that say for the rest of the year? Is the market going to keep going higher? Is it going to go make new highs? A lot of the predictions are that it is. But what happened is that we had that, nosebleed of a fall. Like I always say to you guys, what do I say? Market steps, that takes the stairs up and then takes the express elevator down. And that's what happened. That was an express elevator going down. I mean, oddly enough, look, if you guys have been watching me long enough, 2, 3, 4 weeks before then, I've been saying, I said, this is how you short the market. This is how you take advantage when things are going down. I talked about volatility index, watch the volatility index. It went from 12 to 65 and it's back to 15. That is, by the way, the volatility index's move was the volatility picking up and volatility getting crushed was the fastest it has ever happened as long as you guys can go back on the volatility index, okay? But then, as I always have said before, last 3 months, if you guys are watching me, I said the market is a good predictor of the economy, meaning markets are 6 to 8 months ahead. Is the market forecasting a recession? Well, this is what happened. So until that mini crash that we had, which I'm going to talk about the reason on the next segment, is we had soft landing priced into the markets. Fed is doing a great job lowering inflation. They're going to start cutting rates shortly, and everything is fine. Well, and then overnight, the sentiment went from soft landing to recession. And that's what happens, right? And then after the two announcements this week on inflation and retail sales, recession was kicked out, and then now we're back to soft landing. That's why we're getting that V bottom that we did. It's called a V bottom. It literally looks like this. It crashes and comes right back, snaps right back up. I will give you my opinion at the end when I'm using my half-ass charts on Thinkorswim. So what has happened is that due to the reason of that crash that we had, because I've been talking about the softening economy with you guys for the last 2 months, right? The indicators are not there. Unemployment's going up. Again, this is all about macroeconomy, but you have to factor in fundamentals into your technicals. And when the market sold off and recession was kind of predicted, you went from soft landing to recession. What happened is interest rate futures are now pricing 8 Fed cuts over the next 12 months. That's a lot. That may bring back inflation, but we'll find out. But, market's 6 to 8 months ahead. Sell-offs happen 6 to 8 months before earnings start declining. And you guys got to watch out. I mean, over the last 60 years, every time the market expected 200 basis points of rate cuts, a recession in the U.S. followed within several months. Now, a lot of people are going to ask, because I'm watching the chat go around, I'm not reading it yet, but I'll bet you some of you ask, aren't low interest rates good for the economy? Absolutely are, but with a lag effect. Just like the higher interest rates took the toll on the economy, but there was a lag of a year, right? Because when the Fed raised the rates, it took them a year to raise them from 0 to 5%. And then the effect took place, and then they wanted to kill inflation that they created in 2000 during COVID in 2020 by raising the rates. Well, the lag effect is over now. So now I said this, it's public. You guys can go watch the previous videos. I said, when they start cutting rates, the market actually will decline. The reason for that is Fed never cuts rates in a good economy. Fed, interest rate cuts or increases are the brake and the gasoline of the economy. Okay, that's how it works. So right now, Fed is thinking economy is slowing down to a point that I have to cut interest rates to give the economy some juice, because if they wait too long, which I think they're behind the curve as usual, they probably should have cut it already. But then by the time they start cutting, the economy is already in a recession, right? You understand the lag effect now? And the interest rate futures pricing 8 Fed rate cuts is up from 4. So that doubled in the next 12 months already. You can watch that. They're called the dot plots. You guys can go figure that out. I don't think 8 is going to be there. I think it's going to be less than 8, but I think it's going to be more than 4. First one coming probably in September after the Fed meeting. And there's another catalyst actually on August 23rd. There is a massive meeting where the Fed is going to the Fed chairman actually is going to have a news conference. So, he may hint, because what they do is they kind of hint about these things. I think, are we going to in a recession? I think we are. Is the market going to follow? Yes, I think it will. Is my bias still negative? Yes, it is. And if they start cutting the rates really aggressively, that market's going to get a signal from the interest rate cuts that things are not as well as they think. And I think earnings estimates are too high. Again, you can follow this 3 months, 6 months from now. If I'm still doing this, you guys will hold me to it. So that's where what my tea leaves are saying at the moment. And this is the interest rate futures, are pricing a recession. Well, recession may be a difficult thing to gauge. There's many things you have to look into it, but yeah. And when, according to this chart, if you guys look at it, when the market is predicting heavy interest rate cuts in the form of, quarter or half points, and it's predicted 8 of them are going to be there to the tune of 200 basis points, interest rate markets are predicting a recession. So we will find out in the next 3 to 6 months if the economic data that's coming out is supportive of a recession or not. But we'll talk more about that.